Bloomberg Audio Studios. Podcasts, radio, news. This is Bloomberg Intelligence with Scarlet Fu and Paul Sweeney.
How do you think the Fed is looking at tariffs, the uncertainty of tariffs?
Let's take a look at the sectors and how they performed.
A lot of investors getting whipsawed every day by news events.
Breaking market headlines and corporate news from across the globe.
Could we see a market disruption, a market event?
Are people just too exuberant out there?
You see some so-called low-quality stocks driving this short-term rally.
Bloomberg Intelligence with Scarlet Fu and Paul Sweeney on Bloomberg Radio, YouTube, and Bloomberg Originals.
On today's Bloomberg Intelligence show, we dig inside the big business stories impacting Wall Street and the global markets.
Each and every week, we provide in-depth research and data on some of the 2,000 companies and 130 industries our analysts cover worldwide.
Today, we'll look at how Pfizer won a bidding war against the Danish drug maker Novo Nordisk for an obesity startup.
Plus, we'll break down how Visa and Mastercard reached a deal with retailers after 20 years of litigation.
But first, we begin with earnings from the media and entertainment giant Walt Disney.
This week, Disney reported fourth quarter sales that fell short of Wall Street estimates. The company also said expenses from a slate of big budget movies, including a new Avatar picture, will weigh on results for the coming quarter.
For more, we were joined by Geetha Ranganathan, Bloomberg Intelligence senior media analyst.
We first asked Geetha for her take on Disney's most recent earnings report.
It came off as a little bit of a lackluster report. I mean, everything, if you look at the fundamental drivers of the company, which is really the parks business brings in about 60% of profits, things seem to be going pretty strong there. We saw a 13% jump in operating profit for the fiscal fourth quarter. Again, the guidance for 2026 seems pretty good as well. But really, Disney really has this very, very tough balancing act. So on the one hand, they have the parks business, they have the streaming business, which is doing really well from a profitability standpoint. But to drag it down, you have the linear TV networks, and then you have the hit and miss nature of, the Hollywood studio business. So, they have to contend with all of those different moving parts. And I think that the drag down from the TV networks and the studios is kind of weighing a lot on the narrative.
Geetha, talk to us about some of their bundling of all their streaming services, particularly that ESPN app that really they put a lot of their real valuable sports programming on that ESPN app. How are the early results in terms of subscriber growth?
So they didn't give us any hard number there, Paul, in terms of the number of subscribers that they got on the ESPN Ultimate product, which is priced at $29.99 a month. But they did talk about, in general, that the traction has been pretty good. They talked about the whole bundling strategy because that is where Disney really wins. I mean, if we've seen some of the numbers, from Disney, we know that 40% of new subscribers actually take the Disney bundle. And this is really going to be the strategy for them going forward, right? You get people in with the bundle, and that's how you kind of stem churn. You're able to take price increases. So it's really going to be the main driver for earnings growth for them going forward. And that's exactly what they indicated.
Paul, I can't remember who said this, but it's so true that the history of media is about bundling and unbundling.
Yep.
We went through this period where everyone cut the cord
Yep.
and everyone unbundled, and now we're back to bundling again, although it's, in these discrete groups where Disney might bundle Disney Plus and ESPN Plus together. And then if you are a T-Mobile subscriber, you might get some other options.
But here's my point. That's fine. Is the consumer better off? And my answer is absolutely not.
It's too confusing.
Yep.
It's way too confusing.
Yep.
Geetha, when it comes to bundling, how much more can they do, though? I mean, I see what you're saying about how it's paying off right now, but I mean, can they continue to innovate on their bundling, or have we reached the limits of it?
I don't think we've reached the limits at all, Scarlet. So I think what they're ultimately aiming for with their ESPN product, and they just introduced the streaming product a couple of months ago. I think ultimately they wanted to kind of become the premier sports destination. So ultimately I wouldn't be surprised if you see a Fox or an NBC or even maybe an Amazon kind of feeding in all of their apps so that you go to this one-stop shop for ESPN and you're able to see all different kinds of sports content, because you're absolutely right, there's way too much of fragmentation. It's becoming a great source of friction for the average consumer. And so I think they're going to seek out a lot more different bundling opportunities. We're already seeing them kind of do something with ESPN Ultimate and Fox One, which is Fox's streaming product that they also just introduced a few months ago. So they're going to look to partner with different media platforms across the ecosystem. And I think that is going to be a source of a great upside opportunity for them eventually.
Is everyone willing to play ball on something like that, Geetha? Or is there someone who's going to say, you know what, you can't get me in here and I own or I have the rights over X number of NFL games?
So actually, that's what we're seeing right now. There is the standoff going on between Disney and YouTube TV, and it's really again, it's just a a game of chicken here. So when it comes to sports content, I have to say Disney has the upper hand a little bit. So if you just kind of look at sports viewing in the United States, Disney has about 40% of sports viewing just with, marquee rights tied to all major leagues, college football, NFL, NBA, MLB, they have it all. So I think it becomes a little harder to say no to them. But again, never say never.
All right, Geetha, I'm reluctant to ask this question, but I feel like I have to. What's the latest on Bob Iger's succession plan?
Yeah, this is the big thing that we're all looking at in fiscal 2026. So James Gorman, who's kind of heading up this whole succession planning committee, Paul, has said that the board will be out with a decision by the end of March. So Bob Iger's contract comes to an end by the end of 2026. So hopefully we do have some kind of clarity on that. Right now, it's really looking like it's going to be internal candidates. I mean, there was some, rumors and buzz about whether they were looking externally, but I think they're going to kind of keep it internal.
Our thanks to Geetha Ranganathan, Bloomberg Intelligence Senior Media Analyst.
We move next to the retail space, and with the holiday shopping season now upon us, it is the most important time of the year for these retailers.
For more on what we can expect in this sector, I was joined by Mary Ross Gilbert, Bloomberg Intelligence Senior Equity Analyst covering retail. I first asked Mary how the holiday season is shaping up and what companies are saying.
If you look at how the holiday shopping is shaping up, I think it looks very positive. So I think we are going to see an increase, and particularly for apparel retailers, that's usually like the largest category that consumers, if you look at those that have been pulled by all the holiday surveys that have been conducted, including the National Retail Federation, and they have over 8,200 respondents in their surveys, and,
wow.
And the other ones are pretty sizable, relatively speaking, around 5,000. So they're showing that there's definitely a higher percentage of shoppers wanting apparel and accessories for gifts. So that should be good news for apparel. But Gen Z is planning to cut back on their overall holiday spending by 23%. Millennials just 1%.
Wow. So the Gen Z, these are the younger folks, maybe tougher time finding a job, maybe student debt. Is that kind of the driver there?
I think that could be part of it. Yeah, it could be the job market situation that might be happening there, because these are really like the 17 to 28-year-olds. So
okay.
We have been hearing some, talk about some of these latest graduates, having a difficulty finding a job. I think it's just probably going to take longer because generally unemployment is still very low, but we're seeing resilience. If you look at the data so far with Bloomberg's second measure for apparel retailers and department stores and off-price, we're seeing good sales coming in for the third quarter, and they'll start reporting their numbers in the next few weeks. So I think we're off to a good start, and I think Black Friday sales are already happening. Macy's is out with 50% off on their private label brand product, and they expect to have other drops every week.
Wow.
So everyone's focused
early
on starting now.
Yep.
With the promotions.
So Mary, economists talk about a K-shaped economy out there. Some consumers, maybe the ones that own assets like stocks and bonds and real estate, doing more than good, and kind of everybody else struggling a little bit, particularly with inflation. How does that get reflected in retail sales? Does it mean you just kind of, if you're an investor, look at, I don't know, the Amazon, Target, where I can get some deals?
Yeah, and that's actually what's happening. And that's why you see, let's say, pretty robust sales overall coming out of off-price. So think of TJ Maxx,
yep.
Ross stores, and Burlington stores. And Burlington's at the very low end. If you look at credit card delinquencies, or, those rates, and a lot of these companies that we're tracking represent the credit card holders for like department stores and for some select apparel brands such as Gap, et cetera. And then when you look at that data, delinquencies are actually lower this year versus a year ago, but not for the very low income, which kind of speaks to what you're talking about, and inflation. Actually, those are up in the teens.
Wow.
For the very
yep.
low income consumer. So think like under 50K.
How about e-commerce, Mary? I know the pandemic, folks are saying, kind of pulled forward maybe 4 or 5 years of share shift from bricks and mortar to digital. What's the e-commerce growth story look like these days?
E-com growth is looking strong. When we look at the data, like I said, for the third quarter that we're seeing from Bloomberg Second Measure, it's showing actually online sales were stronger at the department stores, except for Kohl's. Kohl's online businesses, not their online business, but actually their credit customer is shopping less, like in the double digits less. So that's kind of an issue for them. But generally, we're seeing stronger pull with online sales there. Now, there is also a delineation between the type of consumer. If it's Gen Z, they tend to prefer shopping more in store. Really? And we see that with Abercrombie and Fitch's Hollister brand. So they are about 70% of their sales are generated online. And then it's the inverse when you look at their namesake brand, Abercrombie, because that consumer those are millennials, and millennials prefer to shop online. So 60% of their sales are being generated online versus in store.
That was Mary Ross Gilbert, Bloomberg Intelligence senior equity analyst who covers retail. Coming up, we'll take a look at why Tyson Foods says it expects flat profits for 2026.
You're listening to Bloomberg Intelligence on Bloomberg Radio, providing in-depth research and data on 2,000 companies and 130 industries.
You can access Bloomberg Intelligence via BI Go on the terminal. I'm Scarlet Fu.
And I'm Paul Sweeney. This is Bloomberg.
This is Bloomberg Intelligence with Scarlet Fu and Paul Sweeney on Bloomberg Radio.
We move now to some news in the pharmaceutical space.
This week, Pfizer won the bidding war against the Danish drug maker Novo Nordisk for the obesity startup Metsera. It's a bid to catch up to rival drug makers after failing to compete with its own weight loss medications.
For more, we were joined by Sam Fazeli, Bloomberg Intelligence Director of Research for Global Industries and Senior Pharmaceuticals Analyst.
We began by asking Sam to tell us why Pfizer won this deal.
Novo's deal had the risk of not being able to pass due to competition issues, FTC issues. And it sounds like the FTC had given Metsera a call saying, look, if you go with that, there's a risk it won't close. So do whatever you think is the right thing for your shareholders. And they did in the end. And Pfizer did up its bid.
Right. So Novo Nordisk won in a way in that Pfizer is paying up more. Does that actually work in Novo Nordisk's favor, or is it still as desperate as it was before to look for some new catalysts in the obesity market?
Yeah. I mean, I'm not going to call Novo desperate. I think they have assets in there. I think they wanted to add some more options to their sales reps' bags over time. So I wouldn't call them desperate, but they're obviously, by going after this, they did say that we need more assets in our bag. So, and Lilly wasn't in the game. So it just gives you that flavor that they are. And I think the market's telling you that. Look at the divergence of the share price performance of Lilly versus Novo Nordisk. There's the market's favoring the drugs that Lilly's got on the market, and to compete, they needed to get some more. So I think this is not the end for Novo at all in this space. There's lots of other interesting obesity assets coming up with different mechanisms. That's the thing that I think the company is now going to have to think about, rather than trying to go after the same mechanism all the time.
So, Sam, all these big cap pharmaceutical companies that you've covered for decades, I kind of always thought they were big diversified portfolios of lots of different drugs and therapeutics, and but boy, when I look at the stocks this year, it seems like there's haves and have-nots. If you have obesity exposure, the stocks are up, and if you don't, they're down. Is that kind of how your world's evolved into over the last several years?
I would just give you one little caveat to that. AstraZeneca. AstraZeneca, I think, is doing fine, and then they have an obesity asset, but it's not their major game. Their big plays in oncology, cardiovascular is there, and they're adding it to it. So, yes, obesity has been the talk of this past 2025. I think it will still be the talk of 2026. But there's a lot more going on in pharma. Neuroscience, diseases of the brain, diseases of mental health are getting much more attention. Cardiovascular, aside from obesity, is getting quite a lot of attention in hard to treat hypertension, etc. I have to tell you, I don't think there's an area, perhaps antibiotics set aside, that is not getting a significant amount of progress across some pharma company somewhere.
Is what happened with Metsera, Novo Nordisk, and Pfizer an unabashed victory for Eli Lilly? I mean, does it just kind of keep on moving forward, or does any of this kind of hurt Eli Lilly's market position?
No, I mean, at the end of the day, there'll be multiple players in this space, as there are now two at least. And I think Eli Lilly is currently very well placed with the assets that they have to compete. And they're showing that they're competing very, very effectively. And in some cases, winning market share from Novo Nordisk.
Our thanks to Sam Fazeli, Bloomberg Intelligence, Director of Research for Global Industries and Senior Pharmaceuticals Analyst.
We move to news from the multinational food company Tyson Foods.
This week, Tyson said it expects flat profits for 2026. This comes as the company's chicken segment continues to help offset its beef losses.
So we had to check in with Jen Bartashus, Bloomberg Intelligence Senior Analyst for Retail Staples and Packaged Food.
We first asked Jen for her take on Tyson Foods' guidance for 2026.
Novo's deal had the risk of not being able to pass due to competition issues, FTC issues. And it sounds like the FTC had given Metsera a call saying, look, if you go with that, there is a risk it won't close. So do whatever you think is the right thing for your shareholders. And they did in the end. And Pfizer did up its bid.
Right. So Novo Nordisk won in a way in that Pfizer is paying up more. Does that actually work in Novo Nordisk's favor, or is it still as desperate as it was before to look for some new catalysts in the obesity market?
Yeah. I mean, I'm not going to call Novo desperate. I think they have assets in there. I think they wanted to add some more options to their sales reps' bags over time. So I wouldn't call them desperate, but they're obviously, by going after this, they did say that we need more assets in our bag. So, and Lilly wasn't in the game. So it just gives you that flavor that they are. And I think the market's telling you that. Look at the divergence of the share price performance of Lilly versus Novo Nordisk. There's the market's favoring the drugs that Lilly's got on the market, and to compete, they needed to get some more. So I think this is not the end for Novo at all in this space. There's lots of other interesting obesity assets coming up with different mechanisms. That's the thing that I think the company is now going to have to think about, rather than trying to go after the same mechanism all the time.
Sam, all these big cap pharmaceutical companies that you've covered for decades, I kind of always thought they were big diversified portfolios of lots of different drugs and therapeutics. And, but boy, when I look at the stocks this year, it seems like there's haves and have-nots. If you have obesity exposure, the stocks are up, and if you don't, they're down. Is that kind of how your world's evolved into over the last several years?
I would just give you one little caveat to that. AstraZeneca. AstraZeneca, I think, is doing fine, and then they have an obesity asset, but it's not their major game. Their big plays in oncology, cardiovascular is there, and they're adding it to it. So, yes. Obesity has been the talk of this past 2025. I think it will still be the talk of 2026. But there's a lot more going on in pharma. Neuroscience, diseases of the brain, diseases of mental health are getting much more attention. Cardiovascular, aside from obesity, is getting quite a lot of attention in hard to treat hypertension, etc. I have to tell you, I don't think there's an area, perhaps antibiotics set aside, that is not getting a significant amount of progress across some pharma company somewhere.
Is what happened with Metsera, Novo Nordisk, and Pfizer an unabashed victory for Eli Lilly? I mean, does it just kind of keep on moving forward, or does any of this kind of hurt Eli Lilly's market position?
No, I mean, at the end of the day, there'll be multiple players in this space, as there are now two at least. And I think Eli Lilly is currently very well placed with the assets that they have to compete. And they're showing that they're competing very, very effectively. And in some cases, winning market share from Novo Nordisk.
Our thanks to Jen Bartashus, Bloomberg Intelligence Senior Analyst covering retail staples and packaged foods.
We move now to quarterly earnings from the global fintech company Circle Internet Group.
This week, shares of the company fell on concern that declining interest rates will weigh on future returns, and this overshadowed better than expected third quarter sales and earnings.
For more, we were joined by Emily Mason, Bloomberg Fintech and crypto reporter.
We began by asking Emily why lower interest rates from the Federal Reserve would be a concern for a company like Circle.
So Circle issues USDC, and that's a stablecoin pegged to the US dollar, and they maintain that peg by holding reserves in cash and short-term treasuries. They keep the yield from the treasuries, and that's kind of how they make money, and that's where most of their revenue comes from. So if interest rates go down, that shows up in earnings, and that causes some concern for investors and analysts.
So what have their recent results been like?
I mean, this is their second time reporting since going public. They, benefited heavily from all the hype around stablecoin, especially before the Genius Act was passed, and their stock performed really well. It's kind of been down since their summer highs, and that's kind of because of the concern from the interest revenue, but also because of some of the distribution partners that they have. They have revenue sharing agreements with Coinbase, for example, who helps distribute their coin.
So if this company for now is kind of a proxy for a money market fund because its earnings track short-term treasury yields, it must need to do more to diversify its revenue streams. What is it looking at?
Yeah, that's what they're doing. And then if you talk to Jeremy Allaire, who's the CEO, he'll kind of say that lower interest rates are actually good for the company because it means that there's higher velocity of money, there's more investment, and then people want faster moving money like stablecoins, and they also might want to use products like their Circle Payments network, which recently is experimenting with like a stablecoin payouts product, which like helps people to pay out globally with USDC. And they're trying to move more USDC volume onto their own platform instead of working with distribution partners like Coinbase, and that kind of could help them as well. But they see the lower interest rates as a positive thing. And also the USD circulating supply is increasing very heavily as they add new partners. So that also kind of could potentially offset the lower interest rates.
Emily, your beat is Fintech and Crypto Reporter. Two things that didn't exist even just a handful of years ago. Talk to us about broadly the kind of the intersection of the growing crypto market and applications like Fintech.
Yeah, I mean, I think what's kind of the most interesting right now is like Fintech, when it came onto the scene, was sort of like building very sleek interfaces on top of its existing financial infrastructure. And then crypto's pitch is much more sort of like rebuilding the financial infrastructure with things like blockchains. And now the conversation is kind of about bringing the traditional world and the traditional financial infrastructure together with crypto rails. And Circle's really kind of sitting at the center of that and trying to bring stablecoin and like integrate that with how traditional markets work. And that's involves a coming together on both sides. Like traditional firms kind of have to upgrade and make their systems interoperable with crypto technology. And then crypto firms also have to kind of move into a regulated environment. And that's been something that Jeremy Allaire has talked about for a long time. Like he really thinks that crypto needs to be regulated, and Circle, that's been a big part of their narrative, is like, we are kind of like the suits in the room and we're going to be regulated. And that's how we're going to go about doing business.
They're kind of the most TradFi of the DeFi world, in other words, if we want to get technical. This is going to be a dumb question, Emily, but we've seen how Bitcoin and the rest of the cryptocurrencies had a pretty rough October. They're struggling to regain momentum. All these digital coins are not the same as stable coins, but is that shift in sentiment and conviction on Bitcoin and altcoins, especially from institutions, affecting demand at all for stable coins? Or are those two just not linked?
I mean, stablecoin is used a lot of the times, like anytime there's a lot of trading happening in crypto, like and in crypto tokens, like stablecoins kind of benefit because they're used to like move in and out of those markets. The stablecoin, the whole point is that it's like a stable currency. It's pegged to the dollar. It's one for one. So the price of it really shouldn't be impacted at all by like crypto market movements.
But does demand affect it? Or does the spillover involve like demand waning for stablecoin or increasing for stablecoin?
I think where like the demand growth for stablecoin is going to come from is like it moving out of a tool for crypto trading. It's going to be like people in countries where the local currency is volatile wanting to hold stablecoin, or people wanting to actually use it for payments, or like stablecoin payouts. Like if you're a US based company and you're employing a bunch of people around the world who want to hold a stable currency like the dollar, the stablecoin is the best way to access it, then you can pay them that way. Like that's where demand for stablecoin is going to come from. I don't think it's like super tied to the trading necessarily. Like people use stablecoin to get in and out of crypto markets. So, they might see more volume if trading activity is high, but their journeys are kind of becoming less linked.
Our thanks to Emily Mason, Bloomberg Fintech and Crypto Reporter.
Coming up, it's the end of an era at Berkshire Hathaway. We'll break down why CEO and billionaire investor Warren Buffett says he is, quote, going quiet.
You're listening to Bloomberg Intelligence on Bloomberg Radio, providing in-depth research and data on 2,000 companies in 130 industries.
You can access Bloomberg Intelligence via BI Go on the terminal. I'm Scarlet Fu.
And I'm Paul Sweeney, and this is Bloomberg.
This is Bloomberg Intelligence with Scarlet Fu and Paul Sweeney on Bloomberg Radio.
We move next to news at Berkshire Hathaway.
Berkshire Hathaway CEO and billionaire investor Warren Buffett said he is, quote, going quiet, marking the end of an era. Buffett also announced his plan to donate more than $1.3 billion to 4 family foundations with plans to, quote, step up the pace.
For more, I was joined by Matthew Palazola, Bloomberg Intelligence senior analyst covering the insurance business. I first asked Matthew his thoughts on Buffett's latest announcement.
We've known it. I mean, so we knew this letter was coming out. He does this every year around Thanksgiving. We also knew he was stepping down as CEO. So not huge surprise in this letter. I think the going quiet thing was kind of took everyone a little bit by surprise. I think maybe the thought was, hey, he's stepping back as CEO, but maybe he'll kind of be out there in the public, and he's still chairman. Yep. So maybe we'd still hear more from him. A little while ago, he said he wasn't going to speak at the meeting, and now he's going to kind of focus on his philanthropic work. And he's also 95 years old. He's maybe a little tired.
Yeah, exactly. And he's going to donate more than $1.3 billion to 4 family foundations and plans to, quote, step up the pace of his charitable giving to his kids' foundations while he's still alive. So that seems to be the point of life he is. Any reason to think that the business strategies, the operations of Berkshire Hathaway may change now that he has kind of stepped back another step, I guess?
So I don't think so right away. So he is always praising his successor, Greg Abel, talking about how he maintains the ethos of Berkshire, and they'll be doing the same thing. I think Abel walks a fine line now where I think over the next couple of years, he will want to put his own stamp and make a name for himself, but also not stray too far from what has led to this massive value creation at Berkshire. So I don't think anything dramatic happens in the near term. You know, we talked about this, I think, in the past. The amount of capital they're sitting on, and Abel is a good capital allocator, at least according to Buffett. Maybe something happens there, special dividend or something like that. No guarantees on any of that stuff, but I could see Abel wanting to put that kind of stamp on the company. Because
again, what we learned, I guess, from the last quarterly release was the cash is now $382 billion. It's a number that's most portfolio managers would know where to start.
It boggles the mind. I think even in the letter he had mentioned there's just not a lot of things that move the needle for them. So they bought a $12 billion company in Allegheny a couple of years ago. It doesn't really move the needle that much. It helped the insurance businesses grow a little bit, but overall for the company, not dramatic. They bought this $11 billion chemical business from Occidental. These are $10 and $12 billion deals, but they're just not moving the needle for the company. So there's not a ton they can do too dramatically.
Historically, why is Warren and the company, what's been their thought about returning cash to shareholders?
Their thought has been, we don't want to do that, right? He even said, Berkshire shareholders have foregone dividends for reinvestment in America, something like that. I forgot the exact line. And that was Buffett's, he likes collecting dividends. He doesn't like paying them. I think he always thought we are the best allocators of this. So if you're a owner of Berkshire shares, would you rather have some money, or would you rather have Warren Buffett invest that money for you?
Right.
I think over the past couple of years, again, they've had so much money that it's been tough for them to invest it in effective ways. But that's been the philosophy.
Yeah, because I guess my response would be, I can put it in cash too, and get similar rates of return to you. And I guess that when it's 10, 20, 50, $100 billion lying around, not that big of a counter argument. Now it's
it's significant, and it helped their earnings over the past couple of years. Just getting 4% on that was a dramatic tailwind to their earnings. So, it didn't do much for the stock after Buffett said he was leaving. That's been the thing that's weighed on it more than anything else. But and you'll see short-term rates going down, so that tailwind diminishing. I mean, I think there is a school of thought that Berkshire, not the same without Buffett, but just maybe not as good at almost all of their things. Now, that's one school of thought. I could see other ones where, still Abel maybe takes a different direction. So that's another maybe catalyst for the shares. But, it's a kind of darker time for Berkshire.
And what's Warren's ownership stake in the company?
So I don't, off the top of my head, I don't remember.
Is he still controlling?
Yeah, for sure.
Yeah.
And
so you're not going to have an activist investor come in here and say, this is just a poor allocation of capital.
It would be impossible. He owns too much. And the A shares, I believe, are 10,000 votes to a B share.
Okay.
He owns most of them. He's going to step up the amount he's giving away, but he still owns too much for anyone else to step in. And should he die, in his will, he would, I think it's over 10 years, his ownership goes to these foundations run by his children, who I can't imagine would, let them kind of immediately fall into the hands of some sort of active investor. I think he'd set a time frame of over 10 years that he'd want that stuff divested. But he does want it divested. He doesn't want them to just hold on to it.
Our thanks to Matthew Palazola, Bloomberg Intelligence Senior Analyst covering insurance.
We move next to the credit card space.
This week, Visa-Mastercard reached a deal with retailers after 20 years of litigation. So for more, we brought in Justin Teresi, Bloomberg Intelligence Antitrust Litigation and Policy Analyst.
We first asked Justin to break down Visa-Mastercard case.
This case has been going on for about 20 years now. Longer. It started before I went to law school, which was a long time ago. There's salt and pepper in my hair, so we're talking about a really, really ancient case. But basically, what a lot of folks don't know is when you have those really valuable premium cards, right, the airline miles cards or the cashback cards, there's a fee associated with those, and it's the merchants who are eating that fee, typically around 3 or 4%. Depending on the varying swipe fee when you use it at a register. So merchants, no surprise, they're upset about that, right? So Visa, big litigation here, the accusation being that they fixed those fees and that, the merchants are basically the ones eating the cost there. So big deal announced between Visa, MasterCard, and merchants would make a little bit more flexibility on the part of merchants here. They could basically say, hey, we're going to take the lower tier version of a Visa or a MasterCard, but we're maybe not going to accept airline miles cards or cashback cards. And then alternatively, they also might have the option of passing those fees onto you, the consumer, at the register if they do take them. So some big changes here in how things are shaping up.
Well, I've noticed in the last couple of 3 years, they are doing that.
Yeah.
I mean, almost every merchant I go to now, I don't know if it's just a state of New Jersey thing, but they're saying, hey, here's the cash price, here's the credit card price.
Yeah, Paul, this is actually a really interesting issue here because state by state, there's a lot of differences in how this actually plays out. In New York, and I see this too, when I go to my dry cleaner, it's like, oh, maybe that's 4% more if I'm going to use my credit card here. That's actually illegal in New York right now to do that, but the enforcement seems to be lacking. This is a new law passed in 2024. There has to be an upfront kind of price on a tag if they're going to pass a surcharge onto a consumer in New York. Massachusetts, Connecticut, you can't surcharge at all. So if this settlement goes through, that's a big question mark too.
Interesting that you say that surcharge is illegal in New York, because what I've seen is the dry cleaner will say, we'll give you a discount if you pay in cash. Here's the regular price, but you get the discount if you pay in cash. So it's no longer a surcharge. Justin, you said that this has been a case that's been around for 20 some odd years.
Yes,
so
yes.
This settlement, is it just going to get caught up in more legal quagmire?
It really could. So last year there was a first attempt at this. This is the second try now, right? And the big issue that blew up the deal last year is that the smaller merchants kind of pushed for the terms that they set in the first place. And big folks like Walmart, et cetera, kind of got iced out from the discussions on that. It seems like that might have happened again here. The National Retail Federation was out saying, wait a minute, what kind of business practice would this be for us to say, hey, we're going to take these cards and not those cards? And they're also criticizing the fee concessions that were part of this deal too for the next 5 years or so. So I think there's still a lot of questions here. There's probably enough changes from last year's deal to get it over the finish line, but there's a big period here with objectors who are going to be weighing in on what they think of the deal. And honestly, the judge last year, she said, look, you guys can do a lot more than you're offering to do in this deal. So is this enough? That's going to be a huge question moving into an approval hearing.
What are the dollar amounts we're talking about here in this?
So it's quadrupled according to the National Retail Federation since 2009. But Visa and MasterCard, they've got 80% of this market for the card fees, right? $111 billion last year alone collected in these swipe fees, according to the NRF. So really massive. But, these companies are also diversifying their streams, right? They're looking into digital wallets and other payment platforms too. So there's a lot more on the table now than there was when this was first brought back in 2005.
And to be clear, this is Visa and MasterCard and merchants. What about American Express? Where does it sit here?
Yeah, so that's another great question. American Express basically settled a version of this lawsuit, or won a version of this lawsuit years ago. Their card acceptance terms are a little bit different. Surcharging isn't really allowed with those when it's not applied to all card types, right? But that begs the question: if you start allowing surcharging through cardholder or through acceptance agreements for Visa and Mastercard, does Amex now have to allow surcharging on its card? So that's another big question mark. If this deal goes through, it really has the potential to impact everything, not just Visa and Mastercard.
Paul, I remember when Amex used to be accepted everywhere, and then after a while, it was like, oh, we'll take Visa, Mastercard, but not American Express.
Yes,
because it was always for the merchants too expensive.
Too expensive. Okay. I can't remember the last time I used my Amex card. Literally can't.
It's there in your pocket, though.
It's in my pocket.
Okay, see, that's the thing. I mean, what does this mean for companies that have corporate cards, Justin?
Yeah, so that's one of the different brackets here, too. So the way the settlement works is that it's going to divide cards into 3 different types. So it'll be commercial cards, standard customer cards, and then premium customer cards. I think the commercial and standard cards, you want that corporate business. I think those 2 really are of the less concern. It's those premium cards, I think, with the rewards that really are on the line here in terms of whether or not they continue to have that universal acceptance everywhere.
So there's so many businesses built around how to gamify your points.
Oh, yeah. I love it.
And how so you do that, Chris?
I absolutely love it. I mean, every day it's like, oh, these Amex offers, what can I get here for this discount?
Do you keep a spreadsheet tracking your spending?
I don't, but I really should, honestly. I mean, it's that good, I think. So
Paul's like, I cannot get into this.
No, but the kids are. Because, I mean, I've noticed it that they really are good at gaming the system.
Yeah.
And to the point where, I'm going to Barcelona for the weekend on points,
Right,
kind of
exactly. And these premium credit cards are almost like coupon books in many ways, right? Because they offer, like $50 a quarter at, well, actually it's $75 a quarter at Lululemon, for instance, under the Amex Platinum card. And then people try to buy a gift card and stack them and use them like a year later. Paul's laughing at me.
Absolutely true. And they carry those really high annual fees. But then again, I always think to myself, look how much I'm getting back for this. It outweighs the fee sometimes, at least in my mind. So there you go.
All right.
What are Visa and Mastercard saying about this?
So they signed on to this deal. They reached this agreement. I think they're pretty happy with the terms of it because that kind of lets them walk away. The issuing banks like J.P. Morgan, Bank of America, all of them are also defendants. They get to walk away from this litigation. The overhang would be removed, right? So it's really the merchants. Are all of the merchants going to sign on? And what do those objections look like in the next coming months to the court?
Our thanks to Justin Teresi, Bloomberg Intelligence antitrust litigation and policy analyst.
That's this week's edition of Bloomberg Intelligence on Bloomberg Radio, providing in-depth research and data on 2,000 companies in 130 industries.
And remember, you can access Bloomberg Intelligence via BI Go on the terminal. I'm Scarlet Fu.
And I'm Paul Sweeney. Stay with us. Today's top stories and global business headlines are coming up right now.